Hello, everyone, and thank you for tuning in to our June investment update. Today, I'm kindly joined by Blair Anderson, who is a Regional Director and Vice President in Dimensional's Client Communication and Practice Management team. He's been with them for over a decade, and Blair works with clients to communicate complex financial concepts more effectively and translating topical events into core investment principles. Hi, Blair, thanks for coming on.
Hey, afternoon, lovely to be here, thank you.
Great. So, the usual general way we work here is that we bring up some slides, and Blair, I think you've already got some prepared for us. So if you wouldn't mind bringing those up now, that would be great.
There we go.
Fantastic. So fairly topical question. When is it going to get better? I think that's been on the tip of everyone's tongue over the last few months. And obviously there's been quite a few events over the weekend, which is quite intriguing as well. So intrigued to hear what you've got to say. And as with all these things, what I might do is interject occasionally throughout the chat. But ultimately it's over to you to run through your slides to give us a macro overview of what's going on in the world and what your thoughts are about when it's going to get better. Over to you.
Absolutely, Mike. Thank you very much. And hello to all of you that are watching. So when we were speaking ahead of this and trying to work out what we might provide some context for, there was all sorts of things that came up, and this title, this idea was actually something that Mike said. He said, maybe we should just talk about when is it going to get better, right? So that's what we're going to do. We're going to provide some context about where we've been, what's been happening within investment markets, and why it ultimately feels like things have been going pretty badly, right? And then we can start answering that question about when is it going to get better. And we're particularly going to start thinking about recessions, the way that investment markets have reacted to those types of recessions, and bring those things back to some of the core fundamental ideas that we have around investments. And ultimately, by the time you finished and you've got yourself caught up, I really want to make sure that you're feeling more educated, you're feeling a bit smarter about investment markets, and frankly, we're feeling a bit calmer. Like, actually, do you know what? Maybe I don't need to worry about this question of when is it going to get better. We're okay. And let's just put this into some context to begin with. So if we were to look back at some long-term numbers across various markets, so we're going to just look at what's happened in the previous 12 months to the end of March of this year. So that's the most recent full quarter. I know we're almost at the end of June, so we'll get the second quarter very, very soon. I'm going to look at it across a range of different markets in that kind of left-hand side, the UK market, Europe developed, overall developed markets and emerging markets. And then on the bond side, we've got UK whole market government bonds, global excluding government bonds, and then also credit bond markets. And look, this is the reason why people are asking, when is it going to get better? Because if we look back on a 12-month basis, we can see some pretty negative numbers. I mean, particularly on that fixed income side, that number of negative 18.69% on that UK government bond market. I mean, my goodness, I'll quantify it later, but this is in fact, this was the worst period of time that we have seen historically for returns. So no wonder people like yourselves are asking, well, when is it going to get better? And even if we were to extend that out to 5 years, right, we can still see, particularly on the fixed income side, some negative numbers, and you look some more positive numbers. And this is the beginnings of that good news and about some of those really important core principles. Once we get out to 10 years, some green arrows. That's the major thing. That's our expectation. Yeah, we can talk about the specific numbers themselves, about how big those numbers are, but this is the place that we're trying to take ourselves. I want to just talk a little bit about Dimensional, though, and who we are and why we're having this conversation. So for those of you that don't know, we're an investment management business. We're a global business. We've been going for well over 40 years. We manage $600 billion of assets under management. The important thing, though, is that circle on the right-hand side, which is around just having one investment philosophy. So regardless of who you were to speak with at Dimensional, if you were to go out to our headquarters in Austin, Texas, or you speak to someone here, or our colleagues that we have in Germany or Australia or Singapore, everyone talks about investments in the same way. We all have one set of beliefs about the way that we think investments work. Now, at its fundamental level, we think that you can beat markets over time in equities and in fixed income. The way that we go about doing that might be slightly different to a more traditional stock picking type way of management. But fundamentally, we've got over 40 years now of track record that says that the way that we think about investment markets really does work. And if I was to try and summarize all of that work and a huge amount of academic evidence, one of the things that's not on this slide is that Dimensional has worked with a number of people who have won their Nobel Prize in economics. Importantly, we've been working with those people for a whole length of their career. We've had very, very recent winners of the Nobel Prize, but we've also had some people that won it for some of their fundamental insights that, going back to the 1960s. But if I was to try and summarize all of that, we might think about 10 major investment principles. And I'm not going to talk to any of these individual investment principles in a second. Instead, I'm going to kind of bring them together and maybe talk about them in aggregate, because they're going to keep coming up as kind of core ideas as we go through. So the first one is just around the idea of market prices and the way that the market looks to aggregate information, right? And at Dimensional, one of the major things that we believe is that the market does a really good job of aggregating everybody's expectations about what's going to happen. And importantly, it's about what's going to happen in the future. And that's a really key piece that we need to keep in mind when we start understanding what's going on now and we start answering this question of when is it going to get better. So the market does a really good job of aggregating all of that information. It's forward-looking. It reacts almost instantly to new pieces of information. And importantly, we think that prices today are fair. And that's kind of worth unpacking because it's a real key to the way we think about investment markets. But it comes from a really sensible set of insights, which is if you think about investment markets and you think about it on any given day, what's happening is that you've got a buyer and a seller coming together with their information, with their preferences, with all of their other opportunities, and they are making a decision about whether they are going to transact or not. And that's the really key piece, is that generally within investment markets, people are not forced to buy or sell. So what happens is the buyer comes and they look at the price and they say, given all of my information, do I want to pay the price that is currently being offered in the market? And the seller on the other side says, well, given everything else that I currently hold, everything that I might want to go out and purchase, am I willing to sell at this price? And so if the buyer and the seller meet at that same price, we can say that that price is fair. It's fair because if the buyer didn't like it, they didn't have to accept it. And it's fair because if the seller didn't like it, they didn't have to accept it. So this lets us get to that idea that actually prices are fair. Just because prices are fair doesn't mean that we just need to accept the market return. There are absolutely some places that we can go that can increase our returns. We're not going to go too much into this, but absolutely we think that you can beat markets, and you do that by focusing on a handful of things within the equity market and a handful of things within the fixed income market, and ultimately through time you end up outperforming the overall market. But there are some other things that you can do to be really smart as an investor, and this is part of that education piece. One of them is about making sure that you practice really smart diversification, and that you ultimately try and avoid outguessing the market, because it's really hard. If I was to bring an analogy, I'd say that investment markets are a little bit like the weather, right? Who watches the weather forecast and says, well, gee, the weatherman has said that in a week's time, it's going to rain. And therefore, I'm just going to assume that in a week's time, it's going to rain. I'm going to take my umbrella with us. Well, no, we kind of check on it every single day and things change and react. It's exactly the same with investment markets. We think that actually there are a handful of things that you want to do to focus on. And then there are a couple of things you need to do around your own behavior and potentially the relationship that you have with someone like Mike, having a relationship with a financial advisor who can really help you understand your own emotions and really look beyond the headlines, because it's really important that we actually understand what's going on, not what the news is telling us that's going on. So what I want to do now is focus a little bit on some data that we have around recessions, because that's definitely one of the ones that has been coming up, and it's totally related to what's going on with inflation and interest rates. So obviously we've had things like inflation stay steady in the UK when we were hoping it to go down. We had the Bank of England raise interest rates in the UK like half percent. That was a surprise. And this is all connected to, okay, but where is the economy going? What's going to happen? Is there going to be a recession? What happens if there's going to be a recession? What are investment markets going to do if they react? So what I wanted to do was go back to a set of US recession data. We're going to go back to sort of that period from 2007 to 2010. We're going to be looking at just the performance of the S&P 500. The reason we're doing the US is because it's going to draw on some later things that we're going to look at. They've got a really long track record. And I think it's just really interesting. The other reason that it's really interesting is because in the US, they have this thing that happens, which is where the National Bureau of Economic Research, NBER, announces when a recession has started and announces when a recession is finished. And it's not just to do with 2 periods of negative GDP growth, which is something that people generally cite. There are some other factors. So it's kind of interesting because there's this group that just announce when there's a recession or not. So what we can do is we can look at the performance of the S&P 500 to kind of the middle of 2009. And what we see is that markets seem to be going down in advance of the recession being announced. Right, so you can see that the S&P 500 fell from that kind of 2,000 to 2,500 range, and it's down under 1,500 by the time that the recession's announced. Now, it goes down a little bit more, but then something interesting happens. Markets start going back up. And it's not actually until the middle of 2010 that NBER announces that supposedly the recession is finished. But markets have already reacted. Markets have already gone up. This is what we were saying about the markets being forward-looking and pricing in all of the information really, really quickly, and ultimately getting us to that fair price, and ultimately getting to that idea that actually we just want to make sure that we think about and we trust the market and we let it do its work through the long run.
Blair, there's a few things you've said, if you don't mind me just interjecting,
Yeah, please.
that sort of echoes a lot of things that we say year on year, really. So just going back a couple of slides, you were talking about not trying to time the market. I think that's a really important point. We always say that it's a classic line, time in the market versus timing the market. And that's just about ensuring that we believe in the asset allocations over the longer term. And that we're not trying to second guess what's going to happen. You know, the weather analogy was a really good one. And then obviously taking into consideration people's emotions. We talked about last year where people were on the sort of investment emotional journey as much as anything else. And, you know, sort of last October, it felt we were very much in the capitulation stage, the fear, the maximum fear side of things. Yeah. And then we've also talked about the fact that markets invariably are 6 to 12 months ahead of what's going to potentially happen within the economy. It's the first sort of litmus test as to what might be coming down the tracks. And then obviously recovery wise, hopefully they're 6 to 12 months ahead as well, because your point, they're always forward looking. Is that a fair sort of summary of how things are?
Yeah, totally. And I think as well that, you know, I think you're spot on around all of these things. And let's just, like, since we've got it up in front of us, I think there's a good thing talking about managing emotions, like you said, Mike, and just thinking about time in the market, not timing the market. Let's imagine that you're back in 2007, 2008, and you don't have the benefit of working with Mike. You read the news, you watch it, and it's like, okay, NBER have just announced a recession. I'm going to sell all of my equity exposure, and I'm not going to get back in until they've said that the recession is finished. Well, look at what happens. Yeah, for the first little couple of months, you feel really good about it, but all of a sudden you're waiting, right? Ultimately, what you've ended up doing is selling low and buying high, which is a really terrible way of making money through time. Okay, so I think you're spot on. We kind of try and need to disentangle ourselves from this cycle. And there's another thing that I think is really important with this, which is that the economy and the financial markets are connected, but they're not the same, right? So it can feel really weird that we're talking in the media, if you read the news, right now in the UK, it's about interest rates going up and mortgages and inflation. And yet, if you actually look at investment markets, they've been going up, certainly in the US. It feels a little odd. But this is the point, is that they're not exactly the same thing, and that ultimately the market is looking ahead. So, Mike, I think you're exactly right. And it's great to hear all of the work that you've been doing around managing the emotions of being an investor, because sometimes it can feel really hard. And yeah, totally. Sometimes it feels really scary and really uncertain. And that's why we need to come back to these core principles and say, okay, has anything changed? Is there anything that I need to do? Now, I said that we focused on the US because it gives us a longer track record. And what we can do is we can say, okay, well, let's just look at all of the recessions that happened within the US. So if we go back to the kind of 1920s, there's been 15 recessions announced within the US. And what we can do is we can look at, okay, well, what was the performance of, say, $10,000 of investable assets put into kind of a total market in the US? And what did that $10,000 investment do over the next 2 years from that recession being announced? And in 11 out of those 15 instances, you actually ended up with a positive return. So it doesn't mean that every single one of these ended up in a in a positive outcome, right? We should be very, very clear. But look, in terms of probabilities and statistics, like I'm going to take 11 out of 15 cases being positive. And in fact, if you took all of these over that 2-year period of time, your average return was 7.8% compounded over the next 2 years. That's a phenomenal return. Now, this is only talking about the stock market. And of course, we would always make sure, or people like Mike would make sure to understand what your risk tolerance is, think about your asset allocation. It's very unlikely that you would just be holding an 100% stock allocation. So once you start taking into consideration fixed income, this takes a different profile because, of course, we know that through time, those two asset classes tend to have a negative correlation, or at least not a perfectly positive correlation, which means that sometimes when investment markets have gone down, fixed income markets might have gone up. And of course, we're only focusing on the US. So if we were to broaden that out a little bit and look across the world, and let's say that we're not focusing so much just on recessions, but we're saying, okay, well, look, maybe the announcement of recessions isn't the market that I want to look at, but maybe I do want to do something after the market has gone down, say 10%, maybe more. Maybe do I really need to do something? Well, what we can do is we can look at the performance of, in this case, the MSCI World Index. That's just developed markets, investment markets. And if we were to look at all of those from 1970 to 2020, to the end of 2022, and we said, okay, when there was a market decline of more than 10%, what happened over the next 12 months? What happened is that you got a really positive return, 13.8%. And if I look at the next 3 years and 5 years, you got back to more like what the average was during that period of time. So if we've just seen the market go down and we go, great, well, geez, now I need to do something. The answer is, well, no, you don't. Going back to that idea of time in the market, not timing the market, actually, if you did something now, it could actually be really detrimental. It would take you a lot longer to get back what you might have lost. Now, of course, there's maybe a next question. We're not necessarily going to answer it now, which says, okay, but maybe could I get ahead of when the market was going to go down? And look, if we had the answer, if we knew when markets were going to go down and they were going to fall, then we would definitely do that. We found no evidence. We found no marker that tells us when markets are suddenly going to go down in a negative sense. And instead, what we found is actually your best course is to stay the course. It's to stay invested, to have an appropriate asset allocation, and make sure that you have something that you can ride out the bumps and the ups and downs of investment markets through time. Because that brings us back to the question of, well, when is it going to get better? And this is just looking at the first quarter of this year. So from January 1 till March 31. And I'd kind of say that it already has. And this is the funny thing. This is why it's interesting to kind of disentangle the idea of the difference between investment markets and financial and the economy, because what's happened during 2022 is you saw those big red negative numbers. Turns out that inflation wasn't transitory, which we were being told. It looked like it was a little bit more entrenched. And then central banks responded by aggressively and historically aggressively raising interest rates. And markets reacted accordingly. They said, okay, wow, well, that's going to change the cost of capital. That's going to change the financing arrangements for companies. If the central banks are raising interest rates, that increases the likelihood of a recession coming. Right? So markets during 2022 reacted incredibly quickly to all of that new piece of information and started forecasting it forward. And then, of course, what's come down and what's happened is that inflation has started coming down. Maybe it hasn't come down as much in the UK, but certainly globally, it started coming down. And then what you've seen is actually the stock market and the bond market starting to look forward and saying, okay, if that's the case, then we can start looking ahead. And actually, things do look positive if we start looking out over 1, 3, 5, 10, and really going forward. And that's where you start seeing these positive returns. And just a little bit of context, if we go back to the beginning of 2001, and I said that those performance of some of those indices, particularly in the bond market, were historically bad. You can see that actually on a quarterly basis, some of the worst quarters that those parts of the market had ever had came last year. So yeah, when we were asking the question and we were saying last year, when is it going to get better? And maybe the opposite side of that is it's really bad right now, right? The truth is that, yeah, on a historic basis, it was pretty bad. But we just have to cycle through another 6 months, 12 months, and all of a sudden we're in a very different position. Hasn't totally erased the negative performance that we've had, but definitely we're in a much better place. And I'm going to make the case that, yeah, when is it going to get better? It already has. And if you've been listening to the great advice from Mike, then you've already been benefiting from this within your portfolio.
Blair, I think it's been quite interesting to see these figures. If we look at what's really gone on over the last 3 to 4 years, when COVID hit, the markets obviously reacted pretty severely. We saw a big downturn in the market, but then as soon as there seemed to be an element of government intervention, furlough scheme was introduced, effectively companies around the world were underwritten by their governments. Things calmed down and the markets returned. And we saw a rally of ridiculous proportions, I think it'd be fair to say, from the bottom of where COVID hit to all the very, very top. In some cases, that was a 30% plus growth in that particular year. And then obviously we've seen the reduction or the pullback mainly in January last year to do with overpriced tech stocks. And then obviously the Ukraine war and then all the implications off the back of Brexit, amongst other things, all coming home to roost, if you like, and then causing problems in terms of the economy, the global economy, not just the UK domestic economy. And so there was a pullback really on that sterling growth that we had off the back of COVID. And sort of we were near the brink then, or could have been in recession territory very, very early on. And obviously the government stopped that from happening. But I guess what we're seeing is the longer term consequences of some of those actions as much as anything else, as well as external influences that we weren't expecting or anticipating. But this is positive in the sense that if you look at where we are and rebase from the beginning of this year, things are moving in the right direction. But I think this is a classic. Data can be interpreted in lots of different ways. And it all depends on when you start and when you end your look at that particular data. If you look over 12 months, less of a good story. Over three months in this particular scenario, much better. But equally, the opposite can be said. Sometimes you can look at it over 12 months and say it's really positive, but over 3 months it's really negative. So it's always, I guess, taking the longer term view and always zooming out on any graph or any performance figures we might see, because things don't look quite so severe when you zoom out and look at the trend that you see over a longer period of time, which you really eloquently showed on one of those graphs with all the arrows, the green arrows.
And I think you're exactly right, Mike, and it actually links really nicely into what I was going to show next, which is that investment markets, or at least the world, always gives us things to be fearful of, right? So if we were to do this, look, you can see all of the major things that happened in the world going back to 1970. This is developed markets, and you can see all sorts of things in here, right? UK's winter of discontent. We had interest rates at 17% during this period of time, right? You look at all of these crises that happened, markets will always give us, or the news will always give us a reason to be fearful. And yet, if you had invested £1 at the beginning of 1970 and you would just let it compound in this, very vanilla index, that's without even getting into all of the things that we might do or others might do to look to outperform the market. But that £1 became £159. That's an astonishing result. Like, if you don't want that compounding, I will happily have it in my portfolio, right? So yeah, absolutely. If we zoom in on any given day, any given month, any given quarter, frankly, any given year, it's not far from a coin flip. Certainly on a daily basis, it's something like, on average, if you look at any given day, the likelihood of it being positive is like 51% or something crazy, right? It is basically a coin flip. But whenever we give ourselves more time, 1 year, 5 years, 10 years, 20 years, the likelihood of us getting a positive return, and frankly, the likelihood of us getting an incredibly resounding result that really drives us towards our goals, well, geez, what an outcome. We kind of joke, some of the people that we have at Dimensional used to be advisors, and they would say, hey, when I was an advisor, my joke used to be, my job is to actually drive you back towards your hobbies. Right? Like, if you're checking in on your investment account balance every day, well, that's fine if you find it for enjoyment, but if it's stressing you out, then we need to find something else for you to do. Okay. And maybe just a little bit of context about how Dimensional fits into this picture. Like I said, there are a handful of things that we think that you can do in order to outperform within equity markets and within fixed income markets. And some of those things are around investing in different parts of the market, overweighting them. Things like smaller companies beat large companies over time, value companies beat growth companies over time. And Mike is well aware of this and is able to implement that effectively for you and your portfolio. So we think that actually the more time we can give ourselves, the more we can just let markets do their work, ultimately let capitalism put your money to work, and ultimately if you put your money to work, you are owed a return on that financial investment on average across all of these companies in the world, then you get really amazing results, like some numbers that, truly can drive a plan through the totality of your lifetime, through your retirement, and frankly, through to multiple generations if you want to. Mike, I have one more thing, but is there anything else that you want to bring up at this point?
I think it's just really picking up on some of the things you've said, are all the things we've talked about over the last 12 months. And I think sometimes it's quite difficult to believe what is being said when you're in that world of pain, or what feels very painful. You've been saving and investing, and it just feels like there's no let up at the negative news that's coming down the tracks. But I think what's interesting is sometimes we get to a point where negative news actually becomes positive in terms of where the markets are going to be going. And then that sounds counterintuitive, doesn't it? But it's, if we are going to be in recession territory, and we know that inflation is coming down and interest rates are going high, and that's sort of working as a mechanism, well, that's a positive from a market perspective. And that's coming back to your point you said earlier, which was the markets are separate from what is going on in the economy.
Yeah.
Two very separate different things. They are linked, but not directly linked.
Yeah.
So go on.
No, I was just going to say they're not exactly the same. You're totally right.
No. And I think from that perspective, that gives me comfort to be able to say to people, well, look, we're having a rough ride at the moment. Yes, we're still having a tough time in the UK, but a couple of things. Firstly, you're invested globally, not just in the UK. And so whilst the UK might be having a more tough time, in fact, the UK economy has been having a tough time for the last 7 or 8 years. And a lot of portfolios have swung more towards Europe and the US. And obviously, certainly other economies seem to have a different economic outlook, and businesses are doing better than maybe they are here in the UK right now. And so a lot of those returns, whilst might not be UK based, by having a diversified portfolio, hopefully we'll start to see those steady gains and those returns coming over the years and months from this point forward.
Yeah, Mike, you're totally right. And a couple of things I might just add on to that. The first was around the market's reaction to negative news. There's some funny things happening in the US in terms of that reaction, where there'll be expectations from economists, from the market in aggregate, about, say, the number of new jobs and job roles that were going to be available within the US and that were going to get filled. And what was happening is that you were finding these estimates coming in above average, as in loads of people are getting jobs and there's loads of open job roles, which you'd think would be a really positive thing. But actually what it meant is that the market was saying, well, that means that interest rates are going to need to go even higher because we're worried about entrenched inflation. So there's this really funny set of things that happen, right? That just, you're right, like sometimes bad news is good news and sometimes good news is bad news. It's all a little bit fuzzy. And then the other thing I was just going to bring out is around that idea of having a globally diversified portfolio. And also sometimes, some people might come and say, well, I do actually feel really good about the UK economy and I really want to be overweight the UK. So, we should buy more UK stocks. And it's like, okay, we should, we should unwind that a little bit and just think about it some more. My favorite example of this is one of the largest companies listed on the UK stock exchanges, HSBC, which, stands for Hong Kong Shanghai Banking Corporation. Right? It's an established UK brand, but it's a choice around where they list. So often these largest companies are actually global companies. They've got global revenues. They might earn quite a bit of that in pounds, but they might earn it in a whole range of different currencies and have different places that they operate in. And that's where, having that globally diversified portfolio is a real benefit for us, so that, we can just benefit from all of those things. Like, why wouldn't you want to do that?
It's a really interesting point. The FTSE 100 is predominantly made up of international companies that just seem to be headquartered here in the UK, and obviously benefited maybe from the currency exchange rate changes, with profits coming back into the UK when the pound is down against various other currencies around the world. But I guess a truer reflection of the UK economy is looking at the FTSE 350, something like that, where you've got a lot of the smaller companies and medium-sized companies that are UK based. I guess that's a better representation of the UK.
Potentially, it's really hard to tell. And then, of course, I guess the larger question is, well, wouldn't you just want to hold all of them?
Yeah.
Why wouldn't we just want to have the benefit of all of that collective human ingenuity, creation, that creative flow? There's a slide that we don't have here, but that we sometimes put up, which is around the number of applications for patents across the world. And it's just going up through time. right? Even during these periods of time when we feel like there are recessions, during 2008, during COVID, there were still loads of people who were out there inventing, trying to create new things, who are applying for patents. That's just a very simplistic view of the world. And yet we just see that this continuous drive towards wanting to do better, get better, and kind of keep everybody moving forward. And we've got the ability as investors to actually benefit from all of that. I think it's a really positive mindset, and it's a really positive message.
Brilliant.
I might
any more slides, Blair?
Yeah, I just have one that shall just sort of bring this all together. And it's really, well, what can you do about this? So we've got all of these feelings, and I totally get it, right? I have those experiences. I work in the investment management industry. So when I see markets going down, then yeah, sure, I'm kind of concerned about this stuff. But what you realize is that no one person, no one individual can control investment markets. We think that it's an incredibly difficult thing to try and actually forecast where they're going tomorrow, let alone some period of time into the future. So getting a focus back on what you can control is really important. So that might be thinking about getting an investment plan that fits what you need. Notice it's not just get an investment plan, it's actually specifically aligned to you, your individual needs, your goals, your risk tolerances. Make sure that we're structuring a portfolio about where we see returns are coming from. Be globally diversified. Make sure you're managing expenses. That's not the same as having the lowest costs. That's just making sure that you're aware of where everything is going. And then finally, just staying disciplined through market dips, swings, ups, downs. And frankly, that's where you all, if you're listening to this, are in a better position, because you're getting to work with someone like Mike who can really understand you. They can give you that expertise and that guidance, so that if you're worried, if you feel like there's something that needs a change, or there's something that has changed in your own life, you've got someone who you can email, who you can give a call, and can really help you. And from Dimensional standpoint, we are all for supporting investment professionals. That's the way that you can access Dimensional funds, is only through investment professionals, because we think that the value that they provide is more than just picking funds. It is around all of those emotional needs. It's about understanding you and your family and your personal situation, and making sure that you can get from wherever you are today to wherever you want to go in the future. So that's all that's from me. It was a pleasure to be invited on. Hopefully I get an invite back, or at least someone else from Dimensional can come and join you and share some of our wisdom. And it was lovely to have all of you with us today. Thank you.
Blair, thank you. Absolute pleasure having you on. And we definitely take you up on that and have you back again at some point in the future. That's all for today, everyone. Thanks for tuning in. We'll be here again in a month's time with another investment market update. But for now, thanks ever so much.